Share screen. All right, so FX replay is basically trading view, but I don't know if y'all can see this. Share. All right, so it's basically trading view, and we got 5 assets. I might need to reduce those. But we've got where you can go from the daily and go all the way down. This is all the way back in like 2017. So you can go all the way down to the 5-minute, the 2-minute, the 1-minute chart, and you can simulate your trading live the same way that you would if it was kind of like similar to if it was a real chart. So you can go forward minute by minute, and then you can see in a safe environment if your strategy is profitable over time. And then you can also test out other strategies. What I was doing before, and I sent it, I think I talked to you about it too, Kobe. If I was in the chart and I was trading and then I got that urge to over trade and I hit like a loss or 2 losses, then I would shut trading view down. I'll go on FX replay and I would just take that over trading urge and I would just put it out here. So I'm losing fake money instead of real money. Because what you'll see, and I don't know if you guys ever ran the stats, but really, if you look at how many times you lose on a low probability setup, if you can eliminate those losses, a lot of us would already just be profitable. So when you overtrade and then you start giving your money back to the market, those small losses begin to add up. And then even when you get that big win, it's like, yeah, you just won this amount. You just got, 3-4% on your account, but your small losses put you down 2%. So it really don't even hit the same way. So your first rule of thumb is once you start understanding how the market works, then you have to understand what conditions are profitable for you. And so if you're not journaling, if you can't look at yourself and say, you know what, every time I trade pre-market, when I'm trying to get ahead of NFP or get ahead of opening price come back on Nas. I'm in my entry. I'm good. We going in my direction. Price come back and stop me out, and then it go in my direction. And that happens like 4 out of 5 times. That one time where it don't happen, it's like I caught the entry between 8:30 and 9:30, and then price ran, and it's like, dang, I'm up for the day. But those 4 times where it stopped me out and then went forward, that put me in a mindset where now I'm feeling like I'm behind. So I'm not even looking at the chart until like 9:20, right? Because I already know 4 out of 5 times if I'm getting in at 8:30, it's gonna come back and I'm gonna either have to take a partial real quick, but it's gonna come back and stop me out, and that's gonna mess with my emotions. So my trading window doesn't open until 9:45-ish. Every now and then I'll do somewhere in that first 15 minutes if it's super clear, but I'm not touching the charts between 8:30 and 9:30. If I ain't get a London setup or some kind of pre-market clean setup before 8:30, then I can't really even touch the charts until 9:30 after market opens. And that's what I'm going over with you all, basically identifying the difference between, well, basically what I want to first do is define primary market drivers. Now, this is a series that I wanted to do because I'm gonna start putting content out there, and I'm not charging nobody for nothing. I may do I'm talking to Sean about it now. I may do a S corp or something because you can write off money that you make, and you can, like, if you go on a trip, you can do a video and write it off or whatever. So for tax purposes, I might do something like that. But that's down the line. But right now, it's like identifying primary market drivers. These are the things that are the reason for the market moving. And you can engage price based on 2 scenarios. You can look at your indicators, your EMA, your MACD, your RSI, all of those things that are basically, they follow the market, right? And then you can also start identifying primary market drivers. Now, if you start identifying the reason why the market drives, the reason why price goes a certain way, the reason why it's delivered, then all of your experience is going to build up and it's going to make you more profitable over time. Because even if you're going into the chart and you losing money, if you're starting to learn why the market moves, you're developing that language so you can kind of understand how the algorithm moves. Those are those success stories where people are like, oh yeah, I've been trading for 3 years, 5 years, and then it popped for me. And now all of a sudden I reach what I call escape velocity, to where now my account is big enough to where even if I make dumb mistakes, my risk management is on point to where it doesn't take me out the game. But as long as you're chasing every little shiny object and you don't know what actually causes the market to drive, it's going to be hard for you to identify what your edge is. It's going to be hard for you to refine a specific model. So I'm gonna go through what some primary market drivers are. If y'all know some, then you can feel free to jump in and pitch it. But a primary market driver is not an indicator. I mean, some indicators maybe. I think Kobe put me on one that actually measures change in character when there's a break of structure and things like that. But most indicators are just indicating what price did over time. It's not even like telling you. It doesn't give you the ability to anticipate where price is likely to go. So you got primary market drivers is your first ingredient to becoming consistently profitable. And so we're going about the ingredients for consistency. This is designed to help traders go from being able to analyze charts well to being able to pull money out of that analysis, because everybody knows this who's been in this game for a minute. You can be a dope analyst and still not master the overtrading or the emotional component to make it consistently pay you out of the market. So first thing, in order to identify what my reason for entry is, like Shane said earlier, if my reasons for entry are not it's not checklist based to where I can just go through that list and identify it. If it's emotionally based, then I'm gonna get inconsistent results. I'm gonna see a setup and I know it's gonna hit, and I might not even fully understand why because I didn't flush out my checklist. But I jump in and I hit, and then the next day I'm on 10. I'm like, man, I'm basically trading Jesus. I can come in here and kill these charts. And you feel that same feeling of confidence, but the market setup is different. And so you see something that's way different from what you saw yesterday, and you still clicking the button with that same level of, all right, I'm gonna drop 5% on this trade. And then it's hitting you. Now you're catching FOMO. Now your feelings getting in because you didn't identify the criteria for entry that drives the market in your direction. So even though on an intuitive level, you recognize something and you knew it would hit, that second time you were trading, you had that false confidence thinking that you were recognizing it because you were still carrying the high over from yesterday. And then if you do it like I used to do it, all those gains you had yesterday, you gave back anyway. And now you're not pulling money out of the market. And so all of that time spent analyzing is time that you lose that you don't get back because you put time in, and because you traded too much, the value of your time being put into the market decreases. So it's a saying that stuck with me that says, he who trades least makes the most. And I started like shifting myself because I like to trade, but it's like, this is not a hobby. This is a business, right? So what I do is I put myself on demo, and my demo account is up crazy. But if I was trading live funds, it would feel different emotionally. I put myself on demo to satisfy the itch to trade, or I'll go in this back testing software to satisfy the itch. But when it comes to live funds, I'm either going to scale down or I need a setup that I can only see going really one way. Like when I think I posted in the chat yesterday, and I was like, I want to see the price. I want to see NFP manipulate down first because I know price is going up. And if NFP manipulates down, because my higher time frame analysis is saying we're going up, we're about to take previous month's high, and then we're going to take, we're probably going to keep going up next week to take that double top up at the top there. If I'm saying that I want us to go this way, once we manipulate down with that first impulse for NFP, you can catch a banger. So if we manipulate it down, right, and then yesterday's settlement price was above, and then above that you got previous month's high, and then above that you got a double top, and then above that you got this liquidity void. The first time you see a bearish PD array fail is you can flip, invert, take that, and you can ride that to the bank. That's your home run right there. But the reason why I didn't really trade, I did trade live on a lunch setup where it took the lunch liquidity and sold down toward the second half of the day. But the reason why I didn't really trade live is because what NFP did is it moved in a direction that I wanted it to go anyway. So the more it moved in my direction, the more my risk to reward was decreased. And you can see, I caught it on the chat. I was like, mark this fair value gap, the first presented fair value gap after NFP news. Why did I mark that out? That's a primary market driver.
On one time frame.
This was on the 1 minute time frame.
Okay.
And so it was the first presented fair value gap after news. I'm gonna pull the chart up just so that y'all can, if y'all didn't see it. Let me see. We had too much momentum. So I said I said it's too much momentum for me to participate. And then I put, this is a small chat that I'll be in sometimes, but I said too much momentum for me to participate. She might react from here, but it's not as clean as if she had manipulated to the downside first. So when we click this chart, we see this first presented fair value gap. Now you got NFP right here. This is the move that NFP had, it impulse up. I wanted us to impulse down because I know we coming for this liquidity right here at 21.99. I've been wanting us to hit this pretty much all week. And we've been moving in this direction, but every time we move close to it and we pull back, I'm like, bet, that's my move because I know price is pulling back just to collect liquidity and rebalance so it can keep going in a higher time frame direction. So I marked this first presented fair value gap, not this one at 8:30, but the first fair value gap after 8:30. This is one of the primary market drivers that you can build a model off of. So your primary market drivers, once you identify what they are, you need to use those to build a model specific to how you trade, and it won't change. Like, you know how I used to trade, what was it, Sean? Where we was trading and it was like divergence with RSI. And man, I used to catch some bangers with divergence. I remember a Chef JPY RSI trade that I caught. It diverged. I caught it in an Asian session. They had like a 3 pip stop loss and it went. And then I'm like, bet I'm up a bag right now. But then the next time I'm catching my divergence, it kept diverging. And I'm like, I'm trying to catch this divergence. I'm entering in, boom, it's diverging more. I'm entering, it's diverging more. And I'm like chasing price all New York session is diverging. And it's like, you just throwing money away. So the RSI divergence doesn't determine where price is going. Price is going where it's going because of a primary market driver. That's a leader. The RSI is a follower. That's not a primary market driver. That's a secondary market tool. So if I'm making decisions with money on something that's secondary, then I'm gonna get burned and I'm gonna get inconsistent results where it looks like it's going and I'm winning for a season, and then the next season come around and now my divergence ain't diverging the way it used to. And now I'm feeling lost. Right now I'm feeling lost in the charts because it's like I don't know what to look for. I don't know where price is going. It's diverging on the 4 hour and it's bullish, and it's diverging on the 1 minute and it's bearish, and it's like I'm chasing 1 minute price and I'm trying to scalp, not knowing what I'm doing. I'm giving money away, right? Because I'm following the shadow instead of following the actual form, right? I'm following like the after effect. So what we want to do is this right here, the first fair value gap. There's a reason why it printed a fair value gap right at 8:37, if that's the right time. And so I'm like, this is a high value PD array. This is a high value area of interest. So once we get into this primary market driver, if we come back here and I know we're going for this liquidity, then I can frame a trade where I can put on risk. And I can do this every single time. I can say my model is that I'm going to trade news, high impact news. I'm going to wait for the first presented fair value gap of news because a lot of people trading the first presented fair value gap after 9:30 now, which is a primary market driver, so it's not going to change. But I'm gonna wait for those news days, and that's how I'm gonna trade news. I got a whole news model. I'm gonna wait for. Now, once we get here, I'm looking for something else called algorithmic signatures. This is where the market is telling you that it's refusing to go lower. I'm not gonna get into algorithmic signatures during this Zoom because that can be a separate Zoom where we identify what's the footprints or the fingerprints to let us know that my area is valid. But right now, the primary market driver, I say I wanted price to come here and then continue to go here. And then we got some other areas. And then what happened? I put, notice how the candles bodies didn't close outside of the news fair value gap. That's an algorithmic signature. We got here, we wicked, but the bodies on the 1 minute time frame kept closing inside of it. So you were able to, I said she's struggling to take this high, might drop after getting up there. See, even in this analysis, I'm not saying she's not going to get up here. I said she's struggling to get up there. So if we sell, we might drop after we get up here. But price is driven toward this liquidity level. And I have a high probability inclination that it's gonna at least get up here. It might keep going. So what happened when we got below when we first opened, right? This is 9:30. You see this blue, that's all of the trading between 414 the previous day and 9:30 when the market opens. That's significant because that's also a framework for a primary market driver. But we came all the way down. We came into this NFP fair value gap. Notice we didn't even go into that first candle. That first candle was invisible, that 8:30 candle. But the first presented fair value gap right here, we came into it, boom, I caught this trade, but we failed to take this high. And we came back into it. And then once I started noticing, we wicked into it, but we didn't close. We wicked into it, but we didn't close. We wicked into it, and our bodies are closing right on that 50% line of that fair value gap. Now, this is letting me know we don't want to come much lower than this. So in this first trade, if I'm in right here and my stop loss is right here, this is going to be uncomfortable for me. But because we're not closing below it, this is a high, you can call it a low risk scenario because you don't want to put a bunch of risk there, but it's higher risk in that price could wick down and then come back up and then reclaim this fair value gap and go where she's going. But what would have been a safer entry is once I see this displacement right here, where we have this fair value gap is called a BISI, buy side imbalance, and sell side inefficiency. Once we see this fair value gap come up and we close all the way above this volume imbalance, I'm gonna tell you what all these things are in a minute. But this is letting me know, yeah, there's algorithmic intent to push us higher. The algorithm wants to go up here because we close above this. We refuse to close below this fair value gap. So between here and here, I'm safe for buys. What did we do? We came back from here. We tapped right back into this BISI and the bottom of this new day opening gap, and we ran all the way up to here. And we went past that too. But those are the primary market drivers. That's an example of primary market drivers that you can build your model around. So let's talk about what some of them are, primary market drivers. And I don't know if I can do some flashcards or whatever, but these are the things that you want to study. When you study in price action, you can use things like EMAs and things like that in order to try to gauge sentiment. But if you want to actually understand why price is moving, you want to start studying the primary market drivers. So the market needs to eat before it moves. That's your liquidity levels. I was talking to Sean yesterday, I think it was, or the day before that, when you were doing the Zoom, Sean, and I'm at Chipotle and we talking about the charts. And there's a guy in front of me and he was like, "Hey, you a trader?" I'm like, "Yeah." He was like, "Man," he was like, "I used to trade." He was like, "I'm working, man. I really want to get back into it." And then like he left out and then he came back in. He was like, "Hey man, can I like have your phone number or something? Because I really want to get back into trade." I was like, bet you can come in. And he jumped into the group or whatever. And I told him, he might even be able to jump on here now. I don't know. But there's the conversation around it yesterday was we were looking for price. I think you were talking about the Sunday open, the first hour of trading of the week, which is another primary market driver. Every single week, there's going to be a first hour. And once you start recognizing that the algorithm moves a certain way, it goes and revisits these price levels, and then it moves in the intended direction, you can build your model around that, and then your model won't fail later because the market conditions changed. I caught this trade off of remember the Trump news when the market rallied?
Yeah.
That first presented fair value gap after Donald Trump tweeted, I marked it out on my charts. Price came down, revisited it, went up. But there was that first 1 minute fair value gap that was still open. And I was calling the Trump fair value gap. And I put it on the chats for a week. And when price was coming back, that was the low before this last rally. Price came back to that news fair value gap that moved the market historic price. Like, I don't know how many points it was, but when it came back and revisited it at the right time of day, pulled the trigger, and then it was off to the races. So what are the primary market drivers? We got equal highs, equal lows, double tops, double bottoms, triple tops, triple bottoms. Those are your liquidity pools. Liquidity levels are a form of primary market drivers because the market has to eat before it moves. So when you see this perfect level of that's how I took yesterday's trade off of the lunch trade, right? It was lunch was creating this range and it just kept going back and forth, creating this range after it took that high that I was looking for. And then price went above this equal high. These equal highs for lunch. This is a liquidity level. We know that lunch starts at 12, so we got another liquidity level down here. This, if I want price to come down here, in order for me to engage, I need price to take this first, and then the impulse that pushes me above there, you see it created this displacement. That fair value gap that pushed me above this level, we broke back down and we closed right here. That lets me know that we just came up here to grab lunch liquidity. So these equal highs right here, that's going to be something that drives the market down. So the market's going to eat and then it's going to move. We came down here. I was a little late getting in because the ideal entry would have been for me to have my stop loss, my entry, my limit right here at the open of this BISI, and price came in, wicked into it, and then dropped. But I was still, the risk to reward was still favorable, knowing that, okay, we took this liquidity. Our next target is at least here. And then if we're going to come here, we probably going to come here too. So I put my my take profit right here. Once we came right here, I ended up, we retraced back into this fair value gap, but we had not hit the objective yet because we hadn't even taken out this low. So I ended up taking my profit right here. And then you see how price took the lunch low and it wicked below, but it didn't close. At this point, I'm already out, but I don't know. We might keep going bullish now because we just took this liquidity right here. Now there's some more liquidity below, but this is a primary market driver. This is a liquidity pool. That means it's a pool of buy stops and sell stops where hedge funds, retail traders, a lot of people have their stop losses right here. They're trying to catch, they catching that divergence. They're waiting for that divergence to diverge on the RSI, and they putting a stop loss right here because the RSI probably spiked up right here, and then this is a double top. So they're like, oh, okay, we got divergence. We're going to come down and melt for the rest of the day. So the algorithm is going to come and take that liquidity. Doesn't care whose liquidity it is. It's not targeting us personally. It's going to come and take this liquidity, and then that's the signal for you to go in and say, okay, now I want to get this liquidity right here. Now, what would have happened if we came here first and then we came up here and did this same price action? I would not have been able to enter because we already took the lunch liquidity objective. Even if it played out, it's lower probability because now we took lunch lows and lunch highs, and I don't know where she's going. But if we took lunch highs first, and it hasn't been doing this as consistently over the last like 3 or 4 weeks. It's been making the high of the day during lunch, and I've been missing a lot of trades because of that. But if we take the high of lunch and we got a reason to go lower, boom, you can be in like Flynn. So liquidity pools, that's your first primary market driver. Remember that the market needs to eat before it moves. If you remember that, you'll save yourself some stop losses because when you don't see a stop hunt, especially if it's a wick and not a body. So if you see a wick below equal highs, a wick below equal lows, and then a body to close above, that's your cue. As long as your liquidity level is marked properly, that we're probably going in that opposite direction. If you don't get that stop hunt, then you might miss the move, but you also miss the stop hunt that could take you out. So if you want your entry to be refined, you have to always wait for a stop hunt, knowing that you're going to miss some moves because it might not stop hunt. Like it might stop hunt on ES. And then you're looking at it like, oh, I want to enter in, but it didn't stop hunt. Your account is protected by not entering. Entering it on demo, because the 3 times, the 4 times that it stops you out, that's gonna create more pain than the 1 time that it goes in your favor and gets you a crazy profit. So wait for the stop hunt. That stop hunt, primary market driver. We opened, we displaced, we came down, we displaced below and closed below what the price that took us up there. Boom, this same fair value gap that took us up there is good to take us back down. So liquidity pools. Next primary market driver is a liquidity void. How many people know what a liquidity void is? Not you, Sean.
Liquidity void.
Not flowing in.
Is it just I don't even know. What is that?
Volume imbalance.
Oh, okay. I know what that is. That's
All
like
right.
a that's like the yeah, I know what that is.
That's the gap between candles. That's now the liquidity void, volume imbalance. I feel like sometimes I see ICT like has a specific name for each thing. So instead of this being just a fair value gap, it is a fair value gap, but it's a buy side imbalance, sell side inefficiency. And then this is also a fair value gap, but it's a sell side imbalance, buy side inefficiency. When you hear all those language and those different words, you're like, man, that's three different things. It's really only one thing. It's a fair value gap. One is going up, the other one going down. But if you don't know the language, it doesn't mean that you can't recognize what it's doing in the charts. So liquidity voids or volume imbalances, these are areas where, like right here, you see this candle. I don't know if y'all can see this. Oh shoot. Right here, you see this candlestick is it ends right here, and then the candle jumps. And before it opens right here, this previous close, there's a void right there. That's a liquidity void. Now, before price goes up and takes this liquidity, what does it do? It taps right back into that volume imbalance for that liquidity void. So if you are looking for price to go here anyway, and you don't have any other reason, this is not a fair value gap. This is not creating a fair value gap. This is creating a fair value gap, but by the time we break above it, we don't come back to revisit this inversion. We just kept going. If you know for sure we're coming to take out these equal highs, and even though it's the lunch hour and you got a conviction there, you can build a model based on this liquidity void. Okay, we created a space. We haven't hit the target yet. I got my limit order right here. I got my stop loss right here. And boom, we tapped in. Or if you know, real confident, you can have your stop loss even higher than that. We tapped in and then we ran. Boom. And then also, I can't quite see it, but it's a good possibility that this same liquidity void, because we don't have buy side delivery, right? We haven't sold past that to close this gap with the candlestick body until we get here. Then we didn't close this gap to close it with a bullish body until we get here. So we got a bullish body, then when we got a bearish body, then the bullish body. So this gap is now closed, but it looks like from the chart here, I don't have an exact thing, that we referred to it again right here before we drop down into this liquidity level, right? So if your model is built on a liquidity void, also known as a volume imbalance, which means there's an absence of trading volume there, and that's why you see a gap. That's one of the areas that you know price is gonna draw back to, right? So what kind of liquidity voids are there? There is your new day opening gap. You might see people call it an end dog. The new week opening gap, which is the absence of price after the week closes last week, and then we open on Monday. There might be a gap, and we could run all the way in a certain direction. But unless we're let's say we start running up at the open of next week, and we starting to chase more buy side liquidity, but there's this gap there. Unless we're super bullish, we probably going to come back and revisit that gap. And once we revisit it, we might wick into it. We might close a body down below it and then come back the next day and close above it and then revisit it and then continue the objective to go bullish. But once you see that volume imbalance and we're not super bullish and you get a reason to go down, that's your target. Price is likely to come back there. We drop in below and we're targeting that, especially if you got another reason to hit that target. Like above, let's say you got a new week opening gap, price is trading in that direction, and right above that new week opening gap, you got equal lows. Primary market driver, that's my target. We going there. We going, even if we don't hit the new week opening gap, maybe ES hits it and Nas doesn't. Maybe SPX hits it and Nas doesn't. But that equal high, that equal lows right above that gap, that's a high probability liquidity pool, because there's two reasons for me to go in that direction. If I'm trading away from it and then we trading back down, then I can catch those home runs, because now I'm holding until we get to those higher time frame targets. When you have your charts and you put them on B adjust where it takes those gaps out, you're taking out pertinent information because price wants to paint above and below those gaps. That's one of the reasons why I was bullish yesterday, because there was this big old new day opening gap that was wide open. It didn't have a bullish body. And I put it in the chat on Thursday. I'm like, I want us to close and paint above this. And if we don't do it now, we'll probably come back and do it later. But now we got liquidity above it. So if I can catch the bottom where we're trading below it, like that entry I was showing you guys, where we got the new day opening gap, and then I can get in right here at the bottom of this new day opening gap, we're likely to close above here, because this is going to give me a daily candle printed above this gap. Now, when price come back down, we got a bullish candle above it. We don't have a bearish candle above it. That could be a reason for me to sell and say, once we get past it, I'm likely to have a protected stop loss, because we closed above it, and we're probably going to continue to close above it for the rest of the day. So once I'm in, I got my entry, I can be at break even, and we can see how high she goes, right? So we got liquidity voids, which is volume imbalance, new week opening gap, new day opening gap. And I know it's a bunch of words. I don't know if this is overwhelming or what, but I wanted to be able to kind of identify it. If it's too much, just throw I don't know, wave a white flag in the reaction. Then we got fair value gaps. I think everybody knows what a fair value gap is. And that's the bullish one and the bearish one. You can call them bissies and sibbies, but just a fair value gap. If you say a bullish fair value gap, people will know what you're talking about. You have open and price levels. Midnight open, which is the 12 a.m. price. You have session open, which is the 9:30 opening price for New York. You got your first hour that Sean is like killing it with, the Creflo, and he'll show you how he's trading on the time frame on the hourly, but he's using the weekly framework to be able to identify it. So his trades might play out over the course of 2-3 days. And the level of the reference point, he's studying, he's back tested this and he studied this. He's studying a primary market driver. So he's like, hey, even on the Zoom 2 days ago, he's like, I don't know how it works. I don't know why it works. I just know it works. He studies something that is primarily responsible for moving the market. And he like, okay, this is gold right here. That's all you need is like 2 or 3 primary market drivers that you can see how they repeat. And then you build your personal model and then you extract profit out of it and don't deviate from the model, right? So that first hour, there's the first hour after the, you have your Asian session from like 7 or 8 all the way to like maybe midnight. But really your Asian session stops when the London session opens. Your London session opens when Frankfurt, Germany starts trading. That's at 2 a.m. That range from 2 a.m. to 3 p.m. is another primary market driver. That's what I call the Frankfurt range. If you go back, especially on ES, take that range, that 1 hour, put like a parallel channel and draw it forward. And look at how many times price in the New York session comes back and wicks that 50% between that high and that low, and then goes in the opposite direction. You all follow me, or is that complicated?
I follow.
Yeah, I'm following.
It does it on gold. It does it on GU. It does it on NAS. Sometimes NAS is a little sloppier, so it might wick below it and then come back and do it. But it does it really well on SPX. So if I'm looking at the hourly chart and we are finding the 2 a.m. hour, this is I usually trade ES since I've been trading futures now, but let me find all right, here's a 2 o'clock hour, right? We're gonna find a parallel channel, and this is the Frankfurt range.
Clear as day, that second bearish candle, wick right off of it.
Right here. And then we wicked right off of, is this New York? Yep, this is New York session. So look, we got New York session, and then this is overnight trading. We came down here, the 10 o'clock. If you're on a 1 minute time frame right here, as a matter of fact, I like FX replay because it'll let you go down to the 1 minute time frame. This is your trading day, right? This is the 8:30 range. I don't know if it was news on this day or not. This is back 8 years ago. But the primary market driver still driving, right? We dropped below. And this another benefit of FX replay is that you can not only go back down to the 1 minute, but do we have, dang, oh yeah, there we go. You can also compare, like I can compare NAS, US 30 and SPX all together. So we're gonna drop down to the 1 minute on here. And this is basically, it's just like TradingView. And on TradingView, you can't, on TradingView, you can't get down this low on this many years ago. So matter of fact, I'm gonna open up, I'm gonna sync the interview and the time. And then we're gonna go to the 1 hour. And clearly Nas is way more bullish than SPX, but we know that they correlate. So we are here, here, here. And the 2 o'clock hour is right there. I'm gonna put a parallel channel on both of them. And we're gonna see how that played out, that first New York session afterward. Now, what do we have? We got 2 primary market drivers. This is Friday, and this is Thursday. So there's a gap between Friday and Thursday right here, right? This is your new day opening gap. When we go forward and we get into New York session, where's New York? All right, here's New York session. What does price do? Price comes down, trades into this new day opening gap, and then it feels this, all this back and forth is rebalancing this liquidity void. So if you come here and you're like, okay, how is price gonna move? You might get choppy price action this day because it's rebalancing all this absence of trading. And then price jumps. Here's Friday. Now we got a new week opening gap. So we got a new week opening gap that overlaps with this first hour of London, Frankfurt. What do you think this area is on the chart? Do you think this is just as significant as any other area, or you think this carries more weight?
More weight.
Exactly, because we've got this thing rebalanced, then we pushing off to the races right here. And what do we do on ES? On ES, this New York session, we tapped into this London move. And then this Friday, we fell. Boom. This would have been a dope entry. And then what happens next week? Next week, we got this new week opening gap right here. What does price do? What time is this? This is Monday. What did Monday do? Monday traded down into the new week opening gap. And then what did she do? Then she ran. After she closed above Frankfurt, what did she do? She revisited this same price level and she ran, probably targeting right here. So we can play that out and see. But I want to go back to this first area where we see the price wicked and go bearish on that Friday. If part of your trading model, and like I said on ES likes to revisit the Frankfurt range and then go its intended direction. NQ will do it too, but NQ will also like wick past it and then come back. So like if you on the 1 minute and you say I'm gonna wait for price to close past this Frankfurt range and I'm gonna set my limit order right here at the 50%, then you can get in. Even all these equal highs, look, they just got ignored. Now I wouldn't enter this trade personally because of the equal highs right here. But you see how price came right to the 50% and went down. If I'm trading for a 2-to-1 risk to reward and I'm looking for this as my entry, you know, I probably wouldn't even have my stop loss here are these equal highs, but you can just see that 2-to-1 risk to reward, boom. You got it right here. At 2-to-1 risk to reward, you can take half and go break even and you still up. If you risk 1% and then it goes up 2%, you take half and you go break even, then you up 1% on your account. And whatever else happens, you know, it ended up going for basically a 5-to-1 risk to reward. You can scale out, you can let it run, you can do whatever. But these types of areas of primary market drivers, you know that price is likely to have a reaction. So dang, we at 125 after. So we got a couple primary market drivers. There are more. And I'm not big on gatekeeping. When you start putting in hours and you back testing and you see something works, and then it's like you can make money off of the charts, I feel like it's crab in a barrel mentality when you be like, I ain't gonna tell it to nobody, because it's like, I mean, you got your own model that you're gonna keep and you might share that with your kids or whatever. But like when the market moves a certain way and you can tell somebody else that the market moves that way, I believe that you get that back. If you give out, I believe you get back value when you give out value. So I want to pause because I don't want to put too much to make it where it feels like overwhelming. We can go into the charts and look at it, but I want to make sure we open up for any questions.
You
So
being
feel
a
free.
blessing out here for sure.
Say it again.
I said you being a blessing out here for sure.
All
Like
right,
you
definitely.
dropping major gems. So and I definitely appreciate it.
Tell in. Tell in.
So we got liquidity pools, liquidity voids, which on here, do you see where the liquidity void is? Even though it's called something different, it's still the same function.
Yep.
Right here, this is the liquidity void. Let me drop down to the 15-minute. We got price dropped down into this. You see, I got my Frankfurt range already. The little indicator is already set to identify it, right? But price came all the way down into this liquidity void, and then we tapped basically the bottom of the new week opening gap, and then that's it. We ran. Now this one, ES or SPX came in and tapped the new week opening gap. Does Nas tap the new week opening gap?
No.
Now I got a question.
Go
No.
for it.
So, you see on that 3-candle push down,
Yeah.
that void right there, would that be a void?
Yes. Man, you got an eagle eye, bro.
So that's would you consider that inverse now?
Not this right here is a liquidity void. Let me put we'll do a volume imbalance. The volume imbalance is bullish though, because it opened lower and then it closed lower, then it opened higher. So even this is hidden though, because you see the body right there. It's easy to see this one right here. And let's say your model is based on liquidity voids, and you saying, okay, here's a liquidity void. Boom, that's bullish. That's bearish. I want us to come back and I want to get in right here. Okay, we got another one. I want to wick right here, but we didn't refer to this one. We came back and referred to this one because this right here, we got the closing price and the opening price, and there's a gap between them. Even though this is a body below, and this would be technically like bearish delivery where it painted a body below it, and then this right here would be bullish delivery where it painted above it. We see price came back and revisited and wicked in, and then it continued upward. Now this is still open. This is still technically open too, because we've got bullish delivery and no bearish. But sometimes, depending on how aggressive the price move is in that direction, you don't get the revisit until later. So like this big old new week opening gap, ES touched it, but NQ or Nas didn't even come back. That means Nas got way more strength. So you see how SPX took out this 830 range low, and then it kept going and it filled this. Nas took out this 830 range low, and then it ran. It said, forget about the new week opening gap. I got somewhere to be. Where is Nas going? I don't know. Let's look on a higher time frame and see if we can identify the draw on liquidity. Did I answer your question, Kobe?
Yeah, we Gucci, bro. Appreciate that.
I don't know where Nas going. This is back in 2017 where 5,600 was an all-time high. That's crazy. So Nas was just gone. I guess it was going, where we at now? Like 20,000? I guess it was going to 20,000 eventually. But so this is an example though. So like if you are looking for if you're looking for, I want to trade the most bullish asset, you see this, gap right here, not filled. This gap right here, not filled. This is opening price. I mean, this is closing price. This is opening price. That's another gap right here. And then we did come in and revisit it right here, and then we pushed up. This gap right here, not filled. We have a lot of bullish momentum on NAS. So even though all of the assets are probably pushing up, NAS is getting there faster. So these technology stocks and all that stuff is just running. So if I'm on a lower time frame on the 1 minute and I'm looking to buy, if I can find an entry where I can participate, let's say I'm looking at SPX and SPX is going into the new week opening gap, but NAS is not, I'm gonna look to participate by buying NAS. So we can go into the 1 minute and find the first presented fair value gap. This is one of those times where it probably tapped the first presented fair value gap and just ran. Sometimes we see first presented fair value gap. It'll tap it and it'll close below it, then it'll close above it, and then it'll run. But sometimes it'll tap it and just keep going.
So question.
Go ahead, Sylvia.
Yeah. So where are you targeting once you get your entry? Where are you taking it to?
In this one, you would have to have a fixed take profit. So some people do, I only trade for a 3-to-1 or a 2-to-1.
Okay.
What I found is when I'm trading against momentum, then I'm trading for a 2-to-1. I'm taking half and then I'm going break even. If I'm trading with momentum, then I'll look for another liquidity level or a gap or something. You got ways that you can try to measure your fib and get the negative standard deviations. I don't know how to do all that. But in terms of if I'm trading bullish, if it's this bullish, I'm gonna probably look for a 2-to-1, and then I'll take half, go break even, and then I'll close it at a set time. So my take profit won't be a price level in this scenario. My take profit will be a set time. It might be 350, or it might be the 3 o'clock hour, power hour. But you can have a take profit as a set time, and you can end up catching a really big trade, or it hits your break even and you still didn't lose. But let's find the first presented fair value gap on this asset. So we're looking for a fair value gap, because now I'm gonna share something with y'all that I ain't really share with a lot of people yet. And I don't know if it's the same, but we got 930 price. All right, there's no PD array that we can find in 930. So we skipped that. That's invisible. 931 is really where we start looking. So this is 931. When I don't see a first presented fair value gap, and I know we took liquidity, I'm looking for the first presented volume imbalance. Now let's see if we can find it. So on the 1 minute time frame, we got, this is the first candle, because this is 31. This candle opens where this one closed. That's not a volume imbalance. This candle opens where this candle closes, not a volume imbalance. We drop down, boom. This candle right here opens where this one closes. And then we have a volume imbalance right here. All right, so now we got this volume imbalance. What do I want to see? I want to see price close bearish and bullish before I look to enter. So we close bearish. Now this volume imbalance is closed on the bearish side. We close bullish. Now we closed on the bullish side. And now I would look to potentially enter if I have a conviction that we're going higher. I don't know what I would target in this because we're already in all-time highs, but I would look to go higher. So let's say we are up here. I would probably put my stop loss. The safest place to put your stop loss is below the stop hunt. So you're not a stop hunt. I would probably put it here because there's technically like a little gap right here, even though this is the first candle, just in case price wants to get froggish and wick off of here. But you can put your stop loss right here below this 830 range, because you know that there are stop losses that are trapped right here, and this is the most bullish asset. To be honest, this would have been a demo trade for me because I know there's an open new week opening gap right there, so I would not have taken it. But price came back, it would have tapped you in based on this right here. We got a stop hunt right here. Now you're in. If you're going 2-to-1, somewhere around here, you breaking even. You taking half and you breaking even, or even just reducing risk. Now, let's say your closing parameters says we're in all-time highs. I'm not going to close until maybe lunch. So right here is lunch. So you would end up closing right here. At 12, you would have gotten, this is 12. You would have gotten basically a risk to reward if you didn't take a partial of 4 to 1 by just closing, having a time-based take profit. I know that kind of, when you start trading on the 1 minute, I don't recommend that until you get comfortable on like the 15-minute first. And when you're trading on the 15-minute, you should have your 1 hour chart open so that you know what the higher time frame is doing. Because the 1 minute can really fake you out and start closing over a volume imbalance over and over again. You're like, oh, we're going bullish, we're going to reclaim it bullish, it's going bearish. And then if you don't have that higher time frame narrative, you don't have it. And in this case, I wouldn't have gotten in that because I'm like, I know we wicked, but we still got this open gap. And I'm confident that we're going to revisit this at some point. Maybe not today, but at some point we coming back down here. My buy entry would be in this new week opening gap that's overlapped with this first hour of trading of Frankfurt. So we're going to go forward a little bit and see what happens for the rest of this day. This is 12:30. And I think we are in a new trading day. So we've got the first move down. This is probably an area that we're targeting up here. This area of bullishness. This is an area where you can trade the weaker asset, because if you see this much strength and you're like, okay, I think we're coming here, you have a reason to go higher. So as long as we close above this level right here, then we're probably not going to come back down. So this wick that pushed us down is probably going to, if we close above it, it's probably going to hold until whatever bullish objective is met, and then we'll see it reverse. All right, now notice that we didn't close above this wick. Now we close above it. So this whole rundown was just to fill this gap. You have price come down and drop all the way into the new week opening gap. What does it tap into? It taps right into this area. It comes all the way down. It's not even, I don't even see anything on this time frame that it could have been targeting. It kind of tapped into this volume imbalance right here on the 5 minute. And then we pushed up and we went into this level. But because this is the weaker asset, we would rather be buying over here. We would rather be selling over here. So if we see how this came down and retraced, like, I don't know, let's say this is like 5%. What did Nas do? Nas came down and barely dropped. This dropped below the 830 range. This dropped below the 830 range again. This dropped below the 9 o'clock low, the 11 o'clock low. Nas is going somewhere. It just dropped right here. So your primary market drivers are still relevant, but you can know based on how you're looking at, how you're comparing these, and based on what we were talking about earlier, algorithmic signatures, this is the more bullish asset. If I'm looking for sales and I'm going against the grain, I'm wanting to sell this one because this one is showing a willingness to go down and rebalance the new week opening gap. It's showing more weakness than this one over here. All right, we got liquidity pools, liquidity voids, like new week opening gaps, new day opening gaps. Those are also known as volume imbalances. So a liquidity void and a volume imbalance is the same thing. A kind of liquidity void would be a new week opening gap. A different kind of liquidity void or volume imbalance would be a new day opening gap. A different kind of liquidity void or volume imbalance will be your first presented volume imbalance, or your gap between this closing price and this opening price. All of these are forms of liquidity voids. We have fair value gaps, right? And when you want to find your significant primary market drivers, you want to find the ones that happen at a certain time. So you got the first presented fair value gap, or like we talked about earlier, the first presented fair value gap after major news. These are things that drive the market because markets is going to want to react from them. the market is gonna want to come back to them as well. So they can operate as a draw on liquidity. Did we ever find the first presented fair value gap with Nas? We didn't. So we found the first volume imbalance over here. And if we're looking to buy, then where's the first fair value gap? Here's the first fair value gap. So let's highlight that. That's a fair value gap, but it's also a primary market driver, right? So when price came and tapped into this first volume imbalance, if we didn't get this entry, when we see price close here, price closes above this first presented fair value gap. Now we have an entry based on another primary market driver where we can get a tighter risk to reward because we've already painted sell side over this volume imbalance, buy side over this volume imbalance, sell side again, and then buy side again. We don't really have a reason to come lower because we've seen that this asset doesn't even want to go down to tap into the new week opening gap. So if I'm saying, okay, I'm gonna put a little bit of risk right here and I'm gonna target this high, boom, that's my 2-to-1, and then I close. I close half. And the rest of my trade, I can just say, I'm gonna go grocery shopping. And I'm gonna close at the end of the day. So on 1%, I got 2% gain. And then I'm gonna keep holding this until the end of the day. And maybe it comes back and takes me out. But maybe on 1% risk, I'm gaining another 11% of reward just because I had a time-based take profit on a super bullish asset. All right, let me open up if there are any questions. So far, we just talked about liquidity voids, fair value gaps, high probability fair value gaps, which the first presented fair value gap is 1. The first presented fair value gap after 9:30. The first presented fair value gap after major news. Now, the first presented fair value gap after major news, that'll work on GU and on EU. First presented fair value gap after 9:30, that might work on most USD pairs, but I haven't back tested that. I've only back tested that on like indices. And then also high probability fair value gaps. I feel like I should pause there and then we can have a second session where we go into some of the other ones. But we can open up. If you guys want to see something on the charts, we can move into it. If y'all got some questions, cool. If not, let me know. We can try to schedule another one.
Are you gonna drop this recording inside the group?
Yeah, my plan is to put it on YouTube.
Okay.
And then
I just want to be able to go back to back reference because I'm in the car right now.
Mm-hmm.
But I'm also taking notes, so that's why I was just asking.
Don't do that. Don't take notes and drive.
Oh no, I'm not driving, but I'm saying I'm in the car.
Okay.
I'm not
I'm
at
like,
home
man,
or anything like that.
the risk to reward ain't there if you're driving, but
Yeah,
yeah.
nah. I'm very safe because I do drive for a living and I do trade, but I'm very safe with what I do. Yeah.
All right. So I know that when we start talking about this, it can sound like too much, right? But the reason why we want to highlight the primary market drivers is so that when you're engaging with price, you identify the why behind it. Because what's going to happen is you're going to refine it down to what works for you. I know that one of the things that is super valuable is an inverted fair value gap. Kobe uses that like clockwork. So you don't have to know everything in order to build a model. The goal is to get people to identify what primary market drivers is specific to them, build a model that works for them, that repeats regularly, if not every day, a couple times per week. And then we can start going into the psychology piece where your model presents, and then you just have to master those inner demons that keep you from over trading, keep you from FOMOing, keep you from over leveraging. And then that psychology piece is a part of the ingredients for becoming a profitable trader, consistently profitable trader. So we've got the primary market drivers that you can use. Those are your building blocks to build your model. The ones that we talked about today include liquidity voids, Volume imbalances, same thing. Those are synonyms. New week opening gaps, new day opening gaps. Volume imbalances, the gap between lower time frame candles. And then the liquidity pools, which include equal highs, equal lows, double tops, double bottoms, session highs, like the high of the Asian session, session lows, the high of the New York session. I mean, the low of the New York session, previous day's high, previous day's low, previous month high, previous month low. All of these are liquidity levels where there are stop losses and buy stops, sell stops resting. So liquidity pools. And if you see my chart, sometimes you'll see certain liquidity pools that I'll use. I'll use lunch liquidity is so valuable. That 12 o'clock hour to 1:30, I didn't know nothing about it, but it is so valuable to the point where that buy, I think, Sean, you were talking about the buy that when price was dropping on Thursday or Wednesday. And I was like, this might be a safe buy right here. And then I'm gonna see if I got the chart on it. The reason why I was looking at that was simply because I knew that there was an unviolated liquidity pool for the previous day's lunch hour. And then price tapped it and then it just ran for like up until now. So it was like 400 points that day and then it just kept going. But it dropped down aggressively to the point where it didn't even look like it was gonna buy. And then it tapped right into that liquidity pool from the previous day's lunch. And then it reversed. And then that first fair value gap after 10 o'clock, I was like, this could be the safe silver bullet. And I think I posted it in Millionaire Mindset as well. And then the next one, I was like, you could even add here. And then it just kept running. And that was like a banger of a day. So liquidity pools, that lunch low, lunch high, that's a liquidity pool. And if we don't tap it the same way we, like you see on that first trade that I posted where it was a sell, where we took the lunch liquidity and then we went down. If we don't do that, let's say we make the high of the day during lunch and we don't come and run that stop first, that's giving me a hint that we're going to come back for that later. So when I start seeing a signature the next day or 2 days later that's going in that direction, okay, that lunch high is still in my crosshairs. So now I know where price is likely to target because I've got my liquidity pool identified, the London high and low, the New York AM high and low, the New York PM high and low. And it can sound like a lot, but you can pick like 3 to 5 of them. And then you can start seeing the market based on that. It could just be previous days high and low. And because price visits these levels, when you start internalizing price by looking at that specific level, then you start to get a feel for it. You can say, I know that I know that SPX likes to leave equal highs and lows in a way that Nas doesn't. And so sometimes if I see SMT divergence and SPX is leaving equal highs and Nas stop hunted and it created a higher high as a wick and it dropped down, I can still take that ES trade because it's probably done. Like Nas did the stop hunt for both of them. It's probably going to keep going and just leave those equal highs until later. So start identifying your liquidity pools, and I can put something out there with the video, like some definitions so that people can know what it is that we talked about and you'll have it as a study tool. The other thing that we talked about was the first hour of trading. That's something that Sean is an expert on. So, he can speak to that probably better than I can because he's back tested it. And it works with his trading style in terms of intra-week trading as opposed to intraday trading.
You said that lunch hours from 12 to 1:30?
Yep, 12 Eastern Standard Time to 1:30.
All right, thank you.
And then after 1:30, I haven't back tested this, but I just, heard on one of those recent videos where I love the first 30 minutes of trading from 9:30 to 10. It gives you so much information on how the day is going to go. Now, I heard ICT say that first 30 minutes from 1:30 to 2 is the PM's equivalent to 9:30 to 10. I haven't back tested that. I don't know if he got the first presented fair value gap after 1:30. I don't really trade PM because my PM win rate is lower than my AM win rate. So usually on PM, unless it's super clear, I'm on demo. But that first 30 minutes when the New York bell hit, And then that first really 15 minutes, 15 to 30 minutes, man, you got so much value. And then the first presented fair value gap, the last one that I'll go over with you guys is the macro fair value gap. Because what makes the first presented fair value gap carry more influence is when it forms. It comes after 9:30, and there's an injection of volume in the market at 9:30 because the New York traders are up and they're in. The high probability, I mean, the high impactful news, 8:30 on Thursday. Every week, Thursday at 8:30, you got red folder news. And a lot of times on Thursday, if you look at the weekly charts, Thursday is the day that it reverses and it goes the opposite direction. It might have been going bullish all week. More often than not, it'll turn around on Thursday during that news cycle, right? That first 1 minute fair value gap after major news, whether it's NFP, whether it's FOMC at 2 o'clock, that carries more weight than just any other fair value gap because of when it formed. So the macro fair value gap, a macro happens from 10 o'clock before the hour to 10 o'clock after the hour. So if you're looking at an hourly candle, go ahead, Sean.
That's Eastern Standard, right?
I'm sorry.
I know we all in different time zones. So
Eastern Standard, but
say that again, because I didn't get that. You said 10 o'clock before the hour and 10 o'clock after the hour.
So 10 minutes before
10
the hour.
minutes, yeah.
And then 10 minutes after the hour. So like XX 50 and then XX 10. So in that 20-minute window, that's your macro. He put some other macros out there, but those I've back tested and it's like clockwork. If you ever look at the charts and you trying to trade that last hour and it just won't give you that final push to your take profit, and you're like, dang, like I don't feel like doing it. If you look at how the price moves at 350, you're gonna see it consistently just start rallying. It's like it'd be like 348, 349, 350, boom. And it's like going for an extra 20 points all of a sudden. But that window also, everything that you internalize for your narrative, during that 20-minute window, it carries more influence. So if I'm looking for SMT divergence, does everybody know what SMT divergence is?
Yes.
Okay.
No, I don't know what that is.
So smart money time divergence, I'll call it that. But smart money divergence, basically you take two assets that move together like gold and silver, and then one asset makes a higher high and stop hunts. The other asset doesn't make that higher high, refuses to stop hunt. The asset that does not make that higher high, it's more likely to sell than the one that does the stop hunt. So if I see gold stop hunt yesterday's previous day high, and then I see silver come up to it but refuse to and starts melting, the first fair value gap that silver creates, I might be able to get in there as long as my stop loss is above that high that it'll refuse to take. And we might be able to take it down to whatever the sell side target is. When you see that happen during the macro time between 10 minutes before and 10 minutes after, it carries more weight. The fair value gap that's created in that macro window carries more weight than the other fair value gaps. Just like the first presented fair value gap we see right here, it tapped into the first presented fair value gap and then it ran. The fair value gaps that are created during the macro time are also fair value gaps that carry more weight. You're not going to always have, when did this little spike happen? This spike happened at 12:51. So the macro time is 10 minutes before the hour. So let's say 12:50 would be the time where we would look at that macro. So if we're looking at 12:50 right here, this is when the macro opened. And then what happened right at 12:50? Boom, we reached down and we stopped below here. What's the fair value gap that happened during the macro? So between 12:50 and 1:10. All right, do we have a fair value gap? No, we really only have one, which is this. So we're going to label that macro fair value gap. All right, so once we closed outside of this fair value gap, we've got this, and let me, I'm gonna put the corresponding same fair value gap over on ES. So we've got 1250. And then we also got the 110. All right, so what did we do here? We dropped below. Do we have any other fair value gaps inside of this macro? Notice I'm drawing this fair value gap, but I'm including that volume imbalance. So right at 1250, the macro kicks in. We dropped so aggressively that we created this volume imbalance. This wasn't like we was just consolidating. It's like, boom, macro kicks in now, boom, stop hunt. The algorithm automatically starts to fulfill this objective. Stop hunt down to this volume imbalance, and then coming back up. Now it's chopping around inside of this macro. And then we get another fair value gap inside of the macro right here. So we got this volume imbalance that we close above. We got this one. On this one, as soon as we close above it, we have a signal that price is going to continue bullish because we close above this fair value gap. What do we see in here? Do we see any divergence between ES or between NAS and SNP? Yeah, we got right here, we have an equal high, and then we've got price that actually created a lower high on ES. So this divergence right here between this low and hold on, why is it not? All right, so this right here, this went lower and this stayed straight, and it's closing and consolidating inside of this macro fair value gap. That's a signal that when we close above it, this might be a buy. Boom, we closed above it. We came back and revisited. We bought. We didn't even really close into it. We just wicked into it. We bought, and then we kept running. This fair value gap carries more weight than, say, this one right here, because this one wasn't formed during the macro. So it's not just what the PD array is, but it's also when it forms. And if you start looking at price, you can say, okay, my trading model is that I look for a fair value gap that happens, but the first fair value gap after 9:30, and then I'm going to watch price every single day on how it interacts with that one fair value gap. I'm studying a primary market driver. I'm going to look at when does price close below it, and then switch around and go bearish. When does price wick into it and then drop bearish? When does price close below it, close above it, and then come back and revisit it to go bullish? I'm going to form all of my analysis around this first presented fair value gap. I'm going to form all of my analysis around previous days, high and low. When does price stop hunting and keep going bullish? When does price stop run and just go below it and keep going? Whatever those ingredients are, we have to identify first what they are, the primary market drivers, and then you can pick from your table, and you building your whole buffet. You're like, okay, I'm gonna use this, 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 and this, and that fits with me. I like to trade and hold. I used to like to swing trade, but I'm trading futures now, and the prop firms don't let you hold. So I had to adapt. I had to learn to intraday trade. And ICT is primarily an intraday trader. Before I was studying ICT, I was studying Wyckoff, which is basically supply and demand with some additional stuff around consolidation. So I will be able to get into a trade and hold it for 2-3 weeks. But I can't. Sylvia, I think we caught a swing trade on Bitcoin, and it was like, I don't remember how many months we held it. Do you remember that?
Of course, man. That was 2020, I think it was.
How long was that trade open for you? Because she held hers longer than mine.
I think I held it for maybe 7 months or so, something like that.
Mm-hmm. And
I was taking
like, this
partials.
is the entry.
Yeah,
we going forever.
Yeah.
And then I got scared and closed it after like 4 months. But
I think it was like 16,000 at the time.
It was 16. That was the entry.
Yeah.
16,000. And I think I closed. I don't remember what price I closed it at, but I remember I had chart envy. I was jealous. She was like, "You close it? Why you close it?" I'm like, "I don't know."
We were supposed to hold that together, yo.
Man, you could have been still holding that trade.
I know, right?
That's true.
But the intraday thing that helped though is, so trading futures had to adjust my psychology. So I'll probably go back into swing trading, but I had to learn like the first fair value gap after news, because I wasn't looking for that when I was holding it for months. It don't matter about a 1 minute fair value gap. But when you start seeing that price is fractal and the stuff that price does on a weekly, it also does on the 1 minute. For a minute, I was even like trying to trade the 15-second. You could catch a really good risk to reward, but it's frustrating when you miss the move and then you like, it's just going too fast. Unless you're in like a really refined area. I'm not dropping down below 1 minute anymore. But the point is, you can have your primary market drivers that fit your personality, and then you can build your model, and then you can refine it, and that's your base model. That's your bread and butter. Then you can start playing around outside of that on demo. You can add to it, you can take away from it, but you got your core ingredients to something that works reliably every single week, maybe 2-3 times a week, but still every single week. And then you don't feel like you miss anything. Like the FOMO that I felt when I had called a Euro USD trade. And I'm like, if you look back for the last 40 years, every time a Democrat entered the market, every time a Democratic president was in the market, the DXY would go up. Every time a Republican entered the market, the DXY will go down, from like Ronald Reagan all the way through Obama. Then we had Obama, Trump, Biden, and then we had Trump. I'm like, there's only one fair value gap left on the weekly time frame on Euro USD. And if we hit this fair value gap and react and we rally for the next 4 years, like that's a banger, mega super trade. I put the analysis out there. I didn't enter it. I saw someone else call a Euro USD swing trade like 3 weeks after the fact. And I had struggled because I'm like feeling like FOMO and like, man, you probably saw my trade idea and it's not even your idea. But at the same time, I didn't have the FOMO because I'm trading intraday. And even though I'm not swing trading and I can still analyze on the swing trade level, I don't have to swing trade in order to be profitable. So I can go in and look at NQ or ES and still extract profits. And so being able to identify something that won't go away, it's a primary market driver, it keeps down FOMO. You might miss a trade, but your model's not going to fail. You got your model built, refined, back tested. So what you missed yesterday? So what the price went and whipped 1,000 points off of a Trump tweet, and you were on your demo saying, I will buy this right now, but I'm not going to buy it. And then boom, 1,000 points. And you see people in your chat that made like 50, 80 grand in 10 minutes, but the market's going to repeat. It's going to do it again, and it's going to do it again. And if you understand what your model is, there's no more chart envy. There's no more FOMO. It doesn't matter. Like you can put your feet up and chill and come back, and the market will still be driven based on those primary market drivers. So look for the things that cause the market to move, not the things that follow. Look for the leader, the fair value gaps, the volume imbalance, the liquidity pools, the first presented PD array at a certain time. Look for the leader that matches your time frame. That's the pioneer for price. The other stuff just follows it. The EMAs and the RSI divergence, all that stuff is following it. That stuff is not going to show you that, man, I probably can find it, but that stuff is not going to show you that day that Trump tweeted, I posted in my chat, like, this is the target. We're going for these equal highs. It's 1,000 points away. It's crazy, but this is what we're targeting. Because the market drivers was there. Like we start closing and stair stepping above that new week opening gap. We started showing more bullishness on NQ than on some of the other assets. There was no reason for us to go back down. And it's like, we still got some unfinished business up here. Then boom, I didn't know he was going to tweet at like 137. I'm just looking at the charts and he sends a tweet. I find out later he put something on the internet talking about today is a good day to buy. I ain't know none of that. All I knew was primary market drivers. Let's look at the chart. I'm in another chat where people are like trying to sell. I'm like, no, matter of fact, we're on the live Zoom, a live trading, and people are trying to sell. I'm like, nah, we might be marrying the wrong bias because we're still the bearish setups keep failing over and over again. The bearish PD arrays, the bearish fair value gap, the SIBI, they keep failing over and over again. Price is telling us it wants something up higher. And there's these big old equal highs on the hourly time frame. We're climbing out of this new week opening gap. And we got that's why I didn't enter. As a matter of fact, we had FOMC at 2:00. And Trump tweeted at 1:37. My plan was for us to drop down the first part of 2:00, and I was going to look for a buy on after 2:30, and then I was going to try to hit those equal highs. And I don't enter trades right before major news like that, so I would not have gotten in, even if I did think the targets was valid. But I didn't feel FOMO. I looked at it, I'm like, oh, the analysis was on point, but I didn't participate because it was against the rules. But the rules aren't going to go out the window when tomorrow comes in. And now what do I have? Now I got a first presented fair value gap after Trump tweeted. And I remember posting in the chat, like, FOMC don't even mean anything right now because this tweet drove the market way past what FOMC would typically do on a high range day. So we wait for price to come back to that fair value gap, and then we buy it. And then watch this. If we buy it and we're wrong and it closes below, then it's going to revisit that fair value gap, and then it's going to be a sell point of interest. So you understand how the market drives, and then you're not feeling like you're lost. So, but I digress. I kept y'all a little longer than I intended. Appreciate everybody jumping in. I'm going to post the video. I'll post the notes from the video. If you have any questions, you can respond to the chat. You can respond in the Telegram, and we can go from there.
Hey, Brandon.
What's up, Shane? I can't hear you. I'll be listening to ICT. He be making you a conspiracy theorist. Like, oh man, they done got Shane. She go. I can't hear you though.
I think my shit just froze on me.
All right, I can hear you now.
Okay. I was saying, what was the settings on TradingView to show the gaps in between the time?
It is make sure your B adjust is off. So let me pull up TradingView real quick. I'm gonna go to one that I don't trade that I don't trade anymore. All right, so this is the Russell. This is the Russell Mini. And you see how you can see all of these gaps on here. But if you click this on, it tries to hide those rollovers, contract rollover. So your gaps will still be on there. They'll be in a different spot. Actually, this one is not. Let me look at the main one, RTY.
Okay, can you hear me again?
I can.
What you said was time? What? My service had went out.
The part about B adjust.
Yeah.
Yeah, it blocks out. It's supposed to make your charts smoother. For whatever reason, this one is not looking smoother to me.
Yeah.
You in 2025. So when you look at your continuous chart, I could probably do YM because I don't trade YM as much as the other ones. Okay, you can kind of see it better on the hourly. But what it typically does is it shows you where the gaps, it hides where the gaps are, especially the
Right.
the rollover gaps. But this recent market, I don't know if I don't see a difference when I'm clicking it now, but usually when I click it, I see where all these gaps disappear. I know
Yeah, it'll show like a solid candle.
yeah, it'll
That's
show
what
like
it was
instead of
on.
having this big gap right here, it'll just be like a fair value gap. And then when you look at the actual price where all-time high is, it changes it. Now, when it does be adjusted, it's not like, let me see if this is. All right, we got, this is 45,570. We know that that's where it's marking the high. All right, there it goes. You see when I changed it and I put be adjust, these look like equal highs.
Yeah.
But they're not actually equal. They're actually, this is the higher.
The higher high, yeah.
No, actually they are equal highs, but it makes it look like they're not equal because it puts more weight on recent price action.
Yeah.
And then it starts manipulating the historical price action so that you can kind of see the chart like a continuous chart.
Gotcha.
But the actual stop losses are, the institutional stop losses are over here. And if I have be adjust on, right? I mean, if I have be adjust off, then right here, I can see that we took this high. So we took all the stop losses. This is where price was December 2024. When I put be adjust on, it pushes that historical price way up here.
Right.
And it looks like we never took that high. So if I'm saying, oh, okay, I'm targeting all-time highs and then I'm a short, then I'm looking at this, my target is way up here somewhere. And I'm thinking we haven't done it, but we ended up taking it already. And we barely took it and then we dropped. So I don't put the be adjust on when I'm doing higher time frame analysis. I'll consider starting to use it recently because all these gaps between days and weeks is making it kind of harder to read. But that just tells you what it does.
Yeah. Okay. I got you.
All right, but definitely appreciate everybody. And like I said, I'll drop once it finishes loading, I'll drop it and put some notes in there too, as far as like being able to study it.
For sure. Much obliged. Much appreciated.
But yeah, appreciate y'all jumping in.
I needed this session before the birthday.
Hey, when your birthday?
Monday, Cinco de Mayo.
Hey, my birthday tomorrow. May baby.
Oh what? Oh what?
Really?
What?
Yep.
Oh, happy birthday in advance.
Fourth be with you. What?
My birthday, bro.
41. Can y'all believe that?
I'm about to be 37.
Still
37.
wet behind y'all ears.
You said you're a week behind? You had a birthday.
I say y'all wet behind you. No, I'll be 44 this year.
Oh, okay.
In the same age.
Hey man, I feel like an old head. People calling me Unc. I'm like, I'm Unc already? Dang.
Yep.
Nah, well, yeah. I mean,
all right, man.
I'm technically an auntie at this point, but you wouldn't be none the wiser. You wouldn't know it if I ain't told you, for real. Most of my friends like, what? You gonna be 37? Yeah, I am.
I'd rather take a birthday than the alternative. So bring me the next year.
For sure. Enjoy your birthday, King. I appreciate you for sure.
All right, y'all as well. Blessings, everybody.
All right.
Thank you for your time, Brandon.
Mm-hmm.